we could see an impact on Canadian oil flows to the U.S. and possibly higher gasoline prices for you, especially all of my friends and listeners and viewers that live in the Rocky Mountain states or the Midwest. You may be right sort of in that target. Let's talk about more of it with American Petroleum Institute CEO Michael Summers and Lipow Oil Associates President Andy Lipow. Mike, I'm going to start with you. You represent the industry. It's a weird spot to be in because there are different relationships with Canada and its oil. What is your message or the message of the American oil industry right now?
Well, let's put this into perspective. The United States produces about 13.4 million barrels of oil a day, but we consume about 20 million barrels of oil every single day. So we do depend on exports into the United States, particularly from Canada. You mentioned it, PADD 2 into the Midwest, about 75% of the oil refined in the Midwest is from Canada. And so we've worked very hard with the Trump administration so that they understand how important those exports into the United States are. And we thank them for that recognition, lowering the tariff from the potential 25% to 10%. But we're going to continue to work with them and hopefully carve out more exclusions for the oil and gas industry.
So you think that, back to you very quickly, that the reduction from 25% to 10% was partly the work of you, API, and maybe the American oil industry to convince the White House, hey, go after tariffs if you want, but this is something that we actually use more of than they do.
Well, one of the most important components of this is that American refiners buy that oil from Canada at a discount. In most cases, it's about a 20% discount. So if you were to put a 25% tariff on that Canadian oil, you're basically eliminating the incentive for us to process that oil in American refineries. So it was very important to us that we carved out this exclusion for American oil and gas, and we're going to continue to work with them to get it down to zero.
Andy, what should consumers expect? Are we going to see prices at the pump go up?
Well, of course, it depends on where you live. Now, if you're in Maine down to Boston, you should be ready to see a 20-cent per gallon increase in gasoline prices as Irving Oil, the major refiner and supplier in that region, is already notified their customers that they're passing through every bit of the tariff to them. If you're in a place like the Rockies, and especially a state like Montana, where those 4 refineries do depend on Canadian production, you could see Canadian producers try to divert some of that oil to the Pacific markets as there's still pipeline space available. And if you were to run short of crude oil, especially in a state like Montana, you could see prices increase there.
20-cent increase, Andy, that's kind of a big deal, although someone said that prices were higher just as recently as this summer. Is that right? Where does that take us back to?
Well, it does take us back to the summertime, and right now we are trading winter-grade gasoline. So in a couple of months, we're going to see gasoline prices increase another 20 cents a gallon just from the switch between the winter and the summer.
So basically, we could see gasoline prices 40 cents higher by the summer of this coming year, or no? Is that putting it too sharply?
No, I think that's exactly right, especially if the tariffs stay in place. And while we haven't talked much about tariffs on Mexico, which had been at the 25% level, the United States is still importing about 500,000 barrels a day of crude oil from them and a couple of 100,000 barrels a day more of refined products. And that's where it starts affecting refining on the Gulf Coast and the East Coast.